So hi guys, this is Chetan Potdar back again, and today I'm going to be talking to you about some very basic concepts about the stocks. A lot of my students have been asking me, so I thought let me make a very quick tutorial about what are the most basic things about the stock market. So this is a presentation made with basic concepts and ideas in mind. It is for students who are completely fresh to the stock market, who don't know. Yeah, it is an oversimplified for beginners to understand. So what are stocks? Stocks is a share in the ownership of a company. Like for example, let's say that you think ITC is a brilliant company and it's doing very well in a business. And because it's doing very well in business, you would like to be a part of that company. So the easiest way for you to be a part of that company would be to buy this shares of that company. So all you need to, like for example, you have 20,000 rupees with you and you want to be a part of ITC as a as a stakeholder. So you will go ahead and buy the stock of ITC, and for 20,000 worth rupees of yours, you will get the stock. So the stock represents a claim on the company's assets and earnings. As you acquire more stocks, your ownership stake in the company becomes greater. When you say stocks, shares, or equity, it all means the same. What are the stock markets? Stocks are traded on exchanges, which are places where buyers and sellers meet and decide on a price. So, for example, you want to buy the stock of ITC. What you're going to do? You are basically going to go to the stock market and buy the stock. Now, there are two major stock markets in India. One of them is called as the Bombay Stock Exchange. Second one is called as the National Stock Exchange. Both of them are situated in Bombay. The Bombay Stock Exchange is a 150 years old organization. National Stock Exchange started in 1994. The National Stock Exchange is much larger than Bombay Stock Exchange today. Now, if you want to buy the shares, how are you going about buying the shares on the stock market? So what you need to do is you need to open a demat account and a broker account with your broker. Yeah, and as you do that, he is going to give you an internet login and a password. You need to log into your account and buy the shares and sell the shares. Alternatively, you could call up your broker and ask him that this is the stock which I want to buy, and he will buy it from you. So basically, buying and selling of stocks and shares can be done from anywhere, provided you have an internet account, and that is the ease of trading into the stock markets. So what are mutual funds then? Mutual funds, simplistically speaking, are a fund which is a collection of different stocks or bonds which are managed by a professional fund manager, and you pay him a certain fee to do that. So let's quickly look at this diagram. You are an investor here, and you have a certain X amount of funds which you want to put into the stock market. So what are you going to do? You are going to put that money into this fund, which is the mutual fund. This mutual fund will in turn invest into securities, and once you are buying into the securities, that will generate returns for you, which is given back to the investors. So you are basically putting funds which buy stocks, which give you return, which you get. So that is the easiest way I could explain to you what mutual funds are. Now there are a couple of reasons why people buy mutual funds. Primary reasons are because of diversification. For a smaller amount of money that you put into the mutual fund, you can buy a lot of stocks, different types of stocks, because it's a fund. You get a professionally managed team of fund managers. Because of their professionalism, you are quite protected. There is a lot of liquidity involved into the mutual fund. You can buy and sell mutual fund in a couple of days, and it gives you the most simplest way of entering the stock market. And the last and the most important is that you could buy mutual fund for as small amount as you want to. Yeah, in India, I think the basic minimum amount could be as low as 2,000 rupees. So for 2,000 rupees, you would be able to buy into a huge portfolio of stocks. It gives you diversification. It gives you lowering your risk. What is stock trading then? Simply speaking, stock trading means basically buying and selling to profit from it. Now, what, when, how, and what price to buy and sell the stock is an art and a science, which we'll learn in the next few slides. So, what do the traders really do? Stock traders try to find a good price to buy and sell a stock. Now, when I say good price, it basically means that you are trying to buy the stock as cheap as possible and then sell that stock as expensive as possible. So you buy cheap, you sell expensive, and that is how you make profits. Yeah. Now, for them to decide what is a cheap price to buy and an expensive price to sell, they take help of price charts. Yeah. In the next few slides, we'll see what price charts. So then what are charts? Charts contain information about the price at which the stocks have been bought and sold. Yeah. They also contain information about the amount of stocks traded, which is known as the volume. So a basics chart will always have two things. It will have what is called as price. Now this is the price of the stock. This one is denoted in candlesticks. Yeah. And then there is what is called as volume. Yeah. So this is the price, this is the volume, and both of them combined together as basic information gives you makes up for what is called as a basic chart. So then what is volume? The number of shares transacted, that is the total transactions of share on the stock exchange, is called as volume. Yeah. Let me give you an example. Let's say there are two parties, only two parties in the stock market today, and party A is selling one stock to party B, and in turn party B is selling one stock to party A, and they keep on continuing doing this the whole day, and they do it 100 times. So the volume is then 100, not 1. It is the number of transacted shares for that particular day is called as volume for that day. Yeah. So remember, total number of transacted shares is equal to volume. So what does going long mean? Buying first and selling later to profit from it is called as going long. Yeah. It is done when the market is going up or is in a bullish mode. Yeah. So let me explain to you from this example. Now this is where the chart or the price has been going up. So for you to go long, you would be buying here, and then as it goes up you would be selling here. So buying here first and selling here later to profit from it is called as going long. It is only done in bullish markets or when the markets are going up. What does shorting or going short mean? Now selling first and buying later is called as going short. Yeah. Let's say for example, this is where the market was going up, but all of a sudden the market turned around and started coming down. Now if you want to profit from this phenomenon, what you're going to do is you're going to sell here first. So first you sell, as it comes down you buy later. What you are doing essentially in this entire structure is you are selling first and you are buying later. You are selling higher, you are buying lower. You buy low, sell high, you are making profits. It is only done when the markets are going down or as in a bearish market. So as a trader, what do you focus on? As a trader, you focus on three things. We focus on buying, selling and stop loss when you're going long, or selling, buying and stop loss when you're going short. Stop loss is an order which helps you to protect your capital and limit your losses. Let me explain this to you a little bit more in detail in the next slide. So in this example, suppose you have bought the stock here, and you are expecting the price to go up. So if you buy here and you sell here, then obviously there is profit. But if you had bought here and for some reason the market had turned around and come down here, then you would have huge losses, isn't it? Because you're buying here and you're selling here. So stop loss is an order which is always put below the buying order when you're going long, so that you limit the losses. So this is also a sell order. So you are buying here, you would want to sell here, but if it turns around, you buy here and you sell here, this would be the small loss which you would take in order to protect your capital. So if you're buying the stock which is going long, stop loss is always below your buying price. But if you would be going short, which means you would be selling here, then stop loss would always be above it. Remember that. Now let me quickly explain to you very basic lingos about the stock market. There are three animals in the stock market, and they are called as the bulls and the bears and the pigs. So let us understand that. Bulls are the people who think that the stock market will go up and hence they buy to profit from it. Bears are people who think that the stock market will go down and hence they sell to book profit or to short sell to profit from it. The pigs are the ones who are clueless and always get slaughtered. They don't know why and what they are doing and hence always lose money. 95% of the stock market is made up of pigs. They really don't know the reason why they are buying or selling. They are not educated. They have no desire to learn and get educated. They want to do things at random and hence they always lose money. Don't be a pig. Now there are three basic emotions in the stock market. There is greed, there is fear and confusion. Let's understand them a little further. When the trend is up, is bullish, there is greed in the market. We use it to go long in the market. Remember, Never ever short the market when there is greed or when the market is going up. Bulls are in control. Fear. When the market trend is down, which is a bearish trend, there is fear and panic in the stock market. Yeah. We use it to go short or exit the existing position. So whenever there is fear in the market, markets are going into a certain sort of free fall. You are going to make money only by one, going short into the market, or two, unwinding your existing position so that you protect your loss, protect your profits from being faded away. Bears are in control when there is fear in the market. A lot of times there is confusion in the market. We call it as non-trending or sideways market. 70%, 60 to 70% of the time, the markets are confused. They have no direction. They just keep on moving sideways. Yeah, that is called as confusion. It is always a smart move to avoid trading or investing when the markets are going sideways. You should be going long only when the markets are bullish. You should be going short only when the markets are bearish. So, what to trade and when? Remember, you always trade greed, you always trade fear, but you never trade confusion. Allow the market to give you a certain direction. So thank you guys, thank you for your time, for listening to me. This was the shortest presentation and the most easiest presentation I could have made for students who are at a very basic level. I hope this has been able to help you out, and do keep in touch. Thanks and bye.